Hello and welcome to another brand new episode of What the FinTech, the podcast from the team behind FinTech Futures and the Banking Technology magazine. My name is Cameron Emanuel-Burns, a reporter at FinTech Futures, and for this episode I'm delighted to say that we're joined by Rachel Altmann, the co-founder and CEO at BeHive, and Noemi Molnar, BeHive's chief behavioural scientist and co-founder. And today we're going to be discussing how behavioural science is shaping modern finance from digital payment psychology to FinTech strategies and consumer decision making. Well, firstly, it's great to see you both again. I believe we first met each other about a month or so ago at Sibos in Frankfurt.
I think so, just a month ago.
And you were just saying, Rachel, you were just in Saudi Arabia. What were you doing there?
Yes, it was very exciting. It was my first time in the region and in Riyadh. I was attending the FII conference, which is organized by PIF. And it's a large gathering of global leaders, NGO representatives, board members, talking about everything about the future and how they're building the future. And I was there to meet some potential people, network, and it was just an incredible opportunity to be a part of that gathering.
Super. And well, of course, I think the listeners would like to know a bit more about you both. So can you give us a bit more information about your professional background, also about BeHive? What are the origins about it? What is it solving?
Sure. So my name is Rachel Altmann. I'm the co-founder and CEO of BeHive. I studied applied economics in my undergraduate degree, and then I got really quickly intrigued by the topic of behavioral economics and behavioral science, and that's when I decided to do a master's at the London School of Economics in behavioral science. And Noemi, maybe give yourself an intro.
Yes, so hi everyone, I'm Noemi Molnar, and I'm currently the chief behavioral scientist at BeHive. And my background is similar to Rachel's in a sense that I studied business and economics, but then I discovered psychology and I was super intrigued by it because it was really helping me to understand how humans actually behave. And there was a lot around how people are irrational. And I saw that people are just not behaving how traditional economic theories describe it. So while I got intrigued, I also found out about behavioral science. So then I did a master's in behavioral economics at City University of London. And then I was even more intrigued about the brain itself and cognition. So then I did another master's in neuroscience at King's College London. And after that, we studied BeHive. And in the meantime, I also studied a PhD program. And I went to Harvard Medical School to do a fellowship there in research. But in the meantime, BeHive really took off, so I stopped that for now, and now I really enjoyed the applied side of science.
Well, incredibly impressive. Yeah, making me judge some of my life choices. But you guys are from Budapest, right? And that's where you're based.
Yes, we're both from Hungary. We started BeHive from Hungary, and the main office is in Budapest, but we work internationally, and our team is very international as well as we have global clients across Europe and the US and beyond.
Super. Okay, so shall we start with the basics? For me, if anything else, can you just talk me through, when we talk about behavioral science in finance, what exactly does that mean? And how is it helping us better understand why people make the financial decisions that they do?
So firstly, let's start with what behavioral science is. And I want to ask you and the listeners, how many decisions do you think we make in a day?
God, I'm not the one being interviewed here. Okay, how many decisions do I make a day? At least 50? Have I overrated it? Have I underdone it?
Yes, a lot under. So we make around 30,000 decisions a day. But this includes, every kind of movement, every intentional thing. So there's a lot that we don't even register, right? And how many of that do you think is unconscious?
Of the 30,000?
Yeah.
I'm going 25,000.
Is unconscious?
Yeah.
Okay. Yeah, so it's around 90% of that is unconscious.
Right.
So this really illustrates how important it is to understand the unconscious and not just the conscious decision-making patterns, because most of our decisions are actually made unconsciously. And that's important because when we think about how to design environments, how to understand people, that's something we have to take into consideration. And this is where behavioral science comes in, because it really tries to understand both the unconscious and the conscious decision-making dynamics and patterns and how people behave. And it's a very multidisciplinary field. It's studied as the intersection of economics and psychology, but now it actually integrates a lot of different disciplines such as sociology, marketing principles. So when we look at a problem, we have to look at it from a very holistic point of view. But obviously, there are some key behavioral economics principles that are the basics of that. And so this is behavioral science in a nutshell. But then there's also behavioral finance, which really looks into these financial decision-making patterns, and it tries to understand the market anomalies and like why people are not actually behaving in a rational way when it comes to their financial decision-making. And it also looks at investor behaviors and just how the markets behave. So this is behavioral finance, and it's a very important topic, but it's also an emerging science. And there's a lot more that will be uncovered probably in the future and with AI. So behavioral science and behavioral finance in general looks into decision-making and how people behave. And when it comes to financial decision-making, this is a very important field. And psychology and behavioral science is especially important because we mostly make irrational decisions. Money is not something we can touch. We don't work well with numbers. So in general, people are not conscious and also not rational when it comes to their finances. But this is not just true for the average citizen, but also for investors and financial experts. And there's a lot of studies that show how irrational they are as well. And this is very important because we usually try to trust these people. But when we look at how they behave and how they make those decisions, it's not always rational. And they fall into the same traps as everyone else does. So that's the power of behavioral science. It's very universal because it goes back to human nature. And so, for example, there was a study where they conducted it with 300 fund managers. And would you think they are more rational than the average people?
You'd like to think so.
Yeah, exactly. But the results showed that they are actually very, very similar. And when they were asked about two options, they were framed differently. One was in a positive framing and the other one was in a negative framing. They actually fell into the trap of choosing based on how it was framed, even though they were actually the same option. It was just framed differently. And it's just really showing you that this is true for everyone. And when we design these decision environments and roles, we have to take into consideration behavioral science and just be very conscious about what kind of traps people could fall into. And this is what we do at BeHive. We understand and we can help change behaviors and how people think and perceive things. And we are one of the few behavioral science consultancies in Europe. And our mission is to design these better environments for people to make better decisions. And we are very focused on the financial industry, and we work with a lot of banks because they actually realize that behavioral science is super important in everything they do. And it's great to see that after around 5 years, they really realized our potential. And at BeHive, behavioral scientists, we have psychologists, we have researchers, but we also have people from the industry and also coming from a consulting background. So we really bring in this multidisciplinary team who has both a very strong research, but also very strong applied skill set.
So I'm really looking forward to this conversation to find out a bit more how it is impacting finances every day. But this one maybe is a bit more in the wheelhouse of our listeners. Look, we're living in an increasingly digital world. I was wondering, how do you think this transformation has actually changed our psychological relationship with money? Are we thinking about it differently than we did, say, 10 years ago?
Yeah, absolutely. So the shift to digital didn't only change how people pay, but it really fundamentally reshaped how people think about money, how people feel about money, but also how we behave with money. And it's one of the most obvious things is obviously it made it more abstract. Payment is more frictionless and it's more present in our daily life. So we can open our applications, our platforms, get instant notifications. And paradoxically, it both became easier to control our money, but also much easier to lose control of. So firstly, money feels less real and spending feels much easier. And the main reason is because of the reduction of this pain of payment. So we no longer have to give up something valuable and physical. So the emotional pain of paying is much lower. And because of this, it's much easier and much less emotionally straining to spend money. And this is true, obviously, for contactless, for one-click, and for buy now, pay later methods as well. So it becomes much more effortless, and emotionally it becomes much lighter. And from a behavioral science perspective, the endowment effect, I think Noemi might have mentioned this as well, has also weakened, which means endowment effect simply means that you value something more when you own it. But in this case, with digital money, it doesn't feel as owned as it used to with physical. So people are more likely to overspend, people are more likely to actually tip more generously, and also to make more impulsive purchases with digital payment versus cash. Another aspect here is on the one side, it of course can give you more control, but it can also lead to much more anxiety. So because of a digital payment, it's increasingly more real time. So you have a constant real time visibility of your finances. You can constantly do balance checks, spending analytics, budget notifications. And while for some people, this can actually create more control and empowerment, for many others, it becomes more stressful and you start to compare yourself to others. So money really moved from this occasional check-in to money as a constant mental presence in your lives. And then one more element here that I think is important to point out is the psychological distance from debt, especially with increasingly more popular buy now, pay later methods that a lot of companies and brands are trying to push through to customers. And this buy now, pay later really creates this psychological distance from debt because it feels much easier to make the payment. Of course, these digital platforms make it really safe and easy and even rewarding to use these methods. So it creates this illusion of affordability and people can get into a lot of complexity, and over time this can really build up. And studies and research has shown that a lot of people, I believe 40% of Americans in a recent study showed that they regretted using buy now, pay later methods as well. So this is something that's really important. So overall, from the negative perspective, it really has exposed people to new financial vulnerability. But of course, the upside is it reduces friction. It became much easier to manage your finances. It can democratize access to financial tools. You have much more access to learn different technologies and different tools. And overall, of course, to better manage your finances if done well.
Well, like I say, it's really fascinating stuff. But what if you are a fintech company listening to this right now? What psychological principles should they really be thinking about when they're designing their products or setting their pricing strategies?
Yes, so there are, I think, different topics that we have to cover here. Firstly, product development, also communication, and then just in general pricing. So when it comes to product development, it's very important for fintech companies to really understand that you have to personalize your products to whoever you are trying to engage and whoever you're designing the product for. And for that, you have to understand their behaviors, how they behave currently, what kind of financial habits do they have, how do they spend money, what do they spend money on, but also not just understand their behaviors, but their psychographics and their personalities, because it will really shift and change of how you have to design products for them. Because if they are, for example, more open to new things, you can design products very differently to when they are really not open and are very risk averse, and they come from this point of view of I want stability, I have a family, for example, versus those who don't have families, who are, traveling the world, who are these more independent users. So you have to understand who are you designing for exactly from the behavioral and psychological perspective. And what we've seen from brands is that they don't have this perspective. They usually just come up with a product that they think will be a good fit for the market, that they think, rationally, this makes sense. People should be buying this product. But they forget that's just one aspect of it. And they sometimes miss out on actually understanding what they need. And this is where the communication bit comes in again. A lot of banks, and actually most banks and neobanks also, communicate in a very functional way. But what behavioral science says, there are different kinds of value that you have to communicate. Functional is just one aspect, but there's also the personal value, the social value, and you have to make sure that you are covering all of this. And so this also means that, for example, when you trying to, for example, sell a product, you have to create a community around it. You have to understand how to engage people in that sense. There's also the personal value, which really is about connecting to their value system. And then there's the emotional value, which is really about engaging their emotions and making those emotional connections, because actually money is emotional. And what banks tend to forget that we don't just have a functional connection and relationship to money, but it's actually a lot more around just how we perceive it and what we want to get out of our income. And this is something that they have to take into consideration. So let's just give an example. How would you sell an umbrella? What would you say to someone? What is it for?
It's raining outside. You need an umbrella.
Exactly. But you could just say, well, there's this waterproof material that you can stretch over your head. Like, that's it. That's the functional description of the umbrella. But that's not what will engage people. It's more like, yes, we can give you something that protects you from the rain. And when you look at how banks communicate, it's a lot about the functional benefits, and they just highlight the attributes, and they use a lot of industry jargon that most people just have no idea what it is, and they don't want to put into the effort to understand it. But again, just like with the umbrella, you have to shift that, and you have to say like, hey, we can empower your savings, we can help you get to your goals, and just that's how you describe what you want to sell. And that's how you should design the products as well. So this is something that we always try to teach our clients. So the perceived value, the functional, emotional, social, and personal side of things, and just that's how you should communicate, covering all aspects. And also just making sure that whatever you put out there is based on actual behaviors and what people need. And then when it comes to pricing, there's this term called choice architecture. And it's basically a tool that we use as behavioral scientists to design these decision environments. And when we design an environment where it's easy to make a decision and where we can also guide how people make decisions, it will be a much better experience. So for example, when you go to the cinema, there's obviously like 3 different sizes of popcorns, but the middle one is just there for you to choose either the small or the big one. You know, most people just don't use the middle one. So there's so many of these principles that you can use to actually nudge people in one way or another. But also the key point here is that you have to make the decision easy. Otherwise, people just won't make a choice, and that doesn't serve anyone because we just don't like to act, don't like to think. So there's a lot we see that people just are overstimulated and there are too many options. It's not easy to understand. It's not personalized. So that's where fintech companies and also banks can just lose clients.
Well, super. Well, if anything, this has proven that I'm wasted here and I should be an umbrella salesman. But okay, so many companies seem to have loyalty programs these days. What is it about these programs that make them so effective from a behavioral standpoint?
Noemi actually touched a little bit about the perceived value framework, which really strongly comes into the loyalty programs as well. But the reason loyalty programs work really well in financial services is because they're not only rewarding behavior, but they're really, if designed well, are working with the way our brains are wired. So just to go a little bit as a background, and maybe Noemi from a neuroscience perspective can add to this later, but before we even think or act, financial stimuli can trigger really powerful responses in our brain and in our body. And this is the same case here. So those reactions of dopamine, anticipation, and rewards, that's what shapes our behavior later. And just taking a simple example, so let's say you are expecting a bonus at work, but you receive a larger bonus than expected. And the feeling that you get from this, that's the dopamine firing. And this is when reality can exceed our expectation. We have this buzz of excitement or the buzz of the unexpected. But our brain learns really, really quickly, and we tend to update our information very fast. And this is something we call the hedonic treadmill. So you're not going to keep the same level of happiness by keep getting the same size rewards, but the next time you're going to need a bigger reward to keep up that satisfaction and that level of happiness. And loyalty programs are actually very much designed on the same mechanism. So every time you earn a point, you get a new tier unlocked, or you have a progress bar where you see you're getting closer to your goal. All of these little steps create this anticipatory buzz of excitement, and that's what keeps you coming back to it. And it's also important to know from a behavioral science perspective that our brains and humans are not only wired to expect rewards, but we're also wired to seek them. So it's not only the outcome that gives us the reward, but the anticipation of that outcome. And this is very true for loyalty programs as well. You're not only there to get that point or to get that reward, but you're really anticipating that unexpected and to receive these smaller rewards over time. And if loyalty programs are designed well, then this is something that can get you into the habit loop. So habits are simply made of 3 key steps. You have a trigger, you have a routine, and then you have a reward. And if this reward is satisfactory, then you're going to come back next time the trigger comes up again. You're going to be engaging in that same behavior again, and you're going to be a part of this habit loop, which eventually will create a habit-forming behavior and create this sustained behavior change. So that's one element on rewards and the reward-seeking system. Another important point here for loyalty programs is switching behavior. So we know that People don't really like to switch. We have this strong status quo bias. We like to stay with our current solutions. And loyalty programs, if done well, can create a really strong friction when coming to switch to other providers and other solutions. And this can be obviously losing your progress. So it can be the sunk cost fallacy that you feel you've invested a lot of time or effort, or you've received a lot of points and you don't want to switch. But it can also be giving up status, progress, or a sense of your social identity or self-identity. So all of these things also make loyalty programs really successful. And then on top of this, we know from behavioral science that we are social animals. We're very much influenced by our surrounding, by our colleagues, our friends, and people who we look up to and who we aspire to be. So loyalty programs, again, if designed well, can bring out this social and personal element of the perceived value framework, so going beyond functional. And it really creates this sense of belonging and this feeling that I'm a platinum member, or I am a part of this club or this membership, this exclusivity, and that can also really create successful loyalty programs that will last.
And we've done some interesting studies in the financial field, and one of the most interesting findings was that, for example, women are more loyal to their banks than men are. So it was just interesting to see how these dynamics shape, and that's true. Like, women are more attached to their banking partners, and they use actually loyalty system even more. And that goes back to what I mentioned, that this whole relationship is so emotional, even if there's mostly just functional value. But to add to why loyalty programs work from a neuroscience perspective, there's actually a field called neuroeconomics. And it covers all these principles from behavioral science, but from a neurological point of view. And it goes to the brain and analyzes it and just really gives you an answer of like, okay, what's that underlying biological mechanism that is in play? So obviously, dopamine is a huge thing when it comes to rewards, and that activates the reward system. And that's why whenever you receive something for behavior or for something that you do, that will be activated. And the better designed the loyalty program is, the more you activate the dopamine system. But Rachel also mentioned this, like the social aspect of it, and that's where oxytocin comes into play. So you really want to create those social bonds, those emotional bonds, and you want to feel safe. You want to feel like you belong. And again, a very well-designed program will play a lot into that, and it will become your identity. And when something is your identity, you don't want to let go of that, because your brain convinces itself that, okay, that's my identity. I have to behave like that. I have to think like that. And there's a lot of hallucinations around that, but it's because it's so like wired into you and your perception that you will act like that. And that's how you can actually change your behaviors and change how people think. And just the third aspect here. So once something becomes a habit, it will become easier for us to do, because then you don't need your prefrontal cortex to think anymore, and you don't have enough cognitive resources to do everything out of willpower. So loyalty programs are great at creating habits that will make our life easier, because it's so automatic and you don't have to think. Because going back to that principle that 90% of our decisions are unconscious, it's because we don't have enough mental resources, first of all, to process all the information, to store the information, and just to act upon that information quickly. So that's why we create these habits, these like quick decision patterns for us that will actually make our life much easier. So because we're not AI yet, we don't have that chip in, that's how our decision making is efficient enough for us to survive and to make quick decisions.
I appreciate, I'm just throwing this at you here, but what is the distinction between, say, laziness or just not having the willpower or the energy to, say, shift your bank, and loyalty?
Yeah, so there's a lot of things that comes into play. Firstly, it's something you perceive as a hard thing to do. So a lot of fintech companies are actually now trying to like say to you, hey, just come in, open a new bank account, and we'll close the previous one for you. So that's like a good way to do, because if something seems hard, we are much less likely to do it. But also you are attached to something, and there's this very strong loss aversion that you don't want to lose something you already have, and there's some risk associated to change. You haven't tried something yet. So actually it's much easier to make somebody switch a bank if, for example, they already have 2 bank accounts and you say, hey, you've been here long enough, you tried it, you are safe here, then it's more likely that they will close the other one. But to say like, hey, I'm going to let go completely, that's a much trickier behavior change to achieve, unless people are super dissatisfied or they are triggered to the point where they say like, I'm not doing this anymore. But if they are like, okay, it's not the best, but I'm fine, they're just much less likely to act unless they are really pushed or somebody else does it for them. And that's why these social norms and social pressures comes into play, because that's the easiest way to change behavior. If you say like all your friends are closing their accounts, then wow, okay, that's a trend I have to keep up, then I'm much more likely to do it. But just on my own, sitting at home, realizing, well, I don't really like my bank, I'm going to switch, that's not going to happen. But if everybody else in the office talks about, oh, I switched, then I will start to think about it and I'm much more likely to do it. And yeah, we don't have enough mental resources to optimize everything. But for some people, for example, finances are their interest, they are so into it, they are optimizing everything, then yes, they might be more likely to switch.
Well, thank you about that. And maybe going to the other end of this, I know, Rachel, you touched upon financial anxiety earlier, but I was wondering how much does that fear or worry actually influence whether people will adopt a new financial technology?
Yeah, financial anxiety has a really big role in whether people adopt to a new financial technology. And it's also important to understand that it doesn't affect people the same way. So for some, financial anxiety could actually be a positive thing. If I feel anxious that I'm overspending, I can't track my finances, then I might actually have an openness to try a new product, try a new platform to better manage my finances. But more often, financial anxiety is a huge behavioral barrier that inhibits people from trying new things, to stick with the status quo, and to just get this decision paralysis where you're unable to, in a sense, act or move, and you're staying with the current ways of doing things. So maybe you really want to start investing, or you really want to manage your finances better, but due to this financial anxiety, you're not going to start. And this is also what we call the intention-action gap. So you have this intention to do better, to learn more, to try out new things, but something, in this case, the anxiety, is something that's inhibiting you to doing so. And one of the important things here, I would say the most common, is this loss aversion or risk aversion that is triggered in your brain. So it's when you avoid trying new tools due to the uncertainty and you're afraid that you're going to be facing a loss. So really, rather than thinking about what could I gain from this, you're going to go into thinking what could go wrong. And in this case, you're just not going to act on your intentions. But the other really, really important thing, I would say personally, is self-efficacy. So this low self-efficacy can have a really strong barrier to trying things out. And this is not only true in finance. This could be for sports. This could be for many other areas of your life. And it's not only a skill, but it's really the perceived efficacy or perceived skill and confidence that you have that can influence on how you behave on your intentions. So it's really important for fintechs and financial services to be able to understand how can we increase self-efficacy and confidence for people to feel more empowered to then be able to start this journey of trying out new platforms and new tools. So I think that's something that is really important in the long term. And also to show personalized support. So we know that different people need different support, and financial anxiety can come from many different areas. So another important thing that we actually work on very often with our clients is how can we better understand our target customers? How can we improve personalization and be able to create personalized solutions and advice and guidance for those specific segments and target groups that we're facing. So maybe for the older generation, you need to support with how to use digital tools, while maybe for the younger generation, it could be about how can you save better, or how can you improve budgeting within your finances. So we really need to understand the differences among people and not treat everyone the same way, and then be able to tackle the self-efficacy challenge from a personalized perspective. And really, it's important to not only focus on building financial literacy, but to really build financial self-efficacy as well, and to empower your customers, because in the long term, confident customers are going to be the ones who will engage more deeply with your products and services, and they will become the ideal long-term client. So it's really in the benefit of both the fintech, the platform provider, as well as the customer and end user.
Oh, super fascinating stuff. I believe you guys have done research around gender differences in investing. So from your perspective, what psychological factors really shape how women approach investing differently than men?
Yes, that's a super interesting topic. Who do you think are better investors?
Oh, God.
Men or women?
Women.
And why do you think?
I'm outnumbered in here, but I think they will take greater care over and maybe put more research into what they're investing into. Oh my goodness. Have I got that right at all?
Yes, you're on the right track. So when we invest, obviously we take risks and we evaluate risks differently. But also, as Rachel mentioned, there's the self-efficacy aspect, and you have to be confident to be able to make decisions. So men tend to be more overconfident than women, and that usually means that they take more risks and they think that, oh wow, I can do this, I'm good at this. But women are less overconfident, are more cautious. So that's one aspect. Also, when there's risk, the two genders perceive it a bit differently. So men usually see risk as a challenge. Wow, there's this opportunity. I know it could be risky, but I look at it as like, wow, this is gonna be good for me. But women usually see it as a threat. So they are they don't have as many positive emotions towards risk as men do. And also they weigh the potential negative consequences more heavily. But also just in general, risk preferences are different among the genders. So women are more risk averse and they often prioritize wealth preservation, whereas men have a greater appetite for risk. And this really this can be seen in the market everywhere, but also especially, for example, in crypto, where there's a lot more men in that whole ecosystem, I would say, than women. But also then these are more like personality traits, but there's just cultural elements as well. So how we raise young girls, they are usually perceived as versed with numbers. They're not as much encouraged to think about money, to think about investments. And so you become less confident because it's not a word that you see as yours. And there's a lot less women in these roles. Obviously, it's changing, but in general, still finance is a very male-dominated field. And this is very important because there's studies which shows that women want female advice. They want female advisors. They want people who look like them, who think like them, because that creates this sense of trust and safety. And this is what banks or neobanks or fintechs have to take into consideration. When you design for women, you just have to engage them differently and you have to personalize the experience for them. And yeah, in general, as you mentioned, when women are investing, they can overperform and they usually overperform men's performance. There was a study by Warwick Business School which studied 2,800 investors and women's investments overperformed by 1.8% over 3 years compared to men's investments. So there's a lot that we have to do here in terms of how many women invest. And also there's the shift in the market that there's going to be a lot of wealth in women's hands in the next decade. So this is a topic that we have to care about a lot and where behavioral science again comes into. And we have to know these underlying dynamics to be able to motivate women to invest.
Wow, really eye-opening stuff. And you've just lost a client for my best friend who's a financial advisor because I'm getting rid of him immediately. Okay, so digital-only banks are becoming increasingly common these days, but they're asking people to trust them with their money without ever setting foot in a branch. What psychological factors are driving that trust?
Yeah, this is a huge topic and it's also something we work in very often, but most importantly, trust in digital banks is built very differently than in traditional banks. So we cannot compare the two. And in digital-only banks, I would say that the interface often becomes the institution itself. So there's no physical building, there is no branch, or there's no place where you can go into. So trust has to be earned in many different ways. But I think the first most important thing that's very different from traditional banks is that it's very easy, or there's a very low barrier to entry for digital-only banks because there is no commitment. The cost of trying usually in most cases and for most platforms is extremely low. So there's really no risk that you're facing to be able to try something out, and trust can be built over time. So I think this is really important point, that you don't need to give up your traditional bank. You don't need to change anything. You can simply create an account in probably less than 3 or 5 minutes. You don't have to sign any contracts. And there's really a risk-free environment, which is a really low barrier to entry, to be able to try all this out. And then trust can also be built over time. So in this case, trial doesn't equal trust, but it's really relatively easier to get new customers in this case. But again, most people still don't use digital-only banks as their primary banks, so it can be used for experimentation, where you can try out different things. It could be used for traveling, it can be used for budgeting, and over time, a lot of people tend to migrate more and more of their behaviors and their financial behaviors towards digital-only banks. So in this case, adoption and therefore trust is really layered. So it can start with curiosity. You want to try out the new platform that everybody is using, or you're traveling to a new place and you feel that this has maybe a feature that will be very useful for you. And then later on, you can build trust and habits and different openness and adoption towards this platform. And over time, trust can be formed. But in terms of what are the key elements that's most important in trust in digital-only banks, I think the first one would be flawless digital experience, which is really what gives credibility in most of these cases. So we can take Revolut as an example. People are absolutely fascinated by how Revolut works, the platform, and a lot of traditional banks are trying to really catch up with Revolut and how are they doing that, how are they doing their communication, their design, and their really user-friendly interface and platform. So I think that is a huge point for how we can start building trust and credibility, which comes a lot from the user experience of the platform. Another one is transparency. So fintechs and digital-only banks are really built on radical transparency. There is no branch to go into, so you really have to be more transparent about your fees, about different actions you can take on this platform and through this app, so people can really trust them by feeling that there is more transparency given compared to traditional banks, and it's easier to understand and see how these digital banks work. Another one is social proof, which is something we talked a lot about today, but I think here it's one of the key is people like peer validation. We look to what others are doing. So Noemi might say, let's split our lunch on Revolut, and I need to have Revolut to be able to split there as well. So there's really a very strong sense of community and social element in building trust in this case. So if you see everybody is using it, and actually fintechs have really, really good communication on how many millions of people are using their platform, what are people's opinions. So they utilize social proof messaging as well. That can really help with trust building and adoption for people who are new to their platform. And then there's also this sense of control and real-time reassurance. So everything is in your hand. You can freeze the card. You can block everything in one moment. You don't need to go to a branch. So it's really, I would say, easy, and it gives a sense of agency and immediacy if there is any issues or any changes which you want to make. But then another point is the human element that is often missing from digital-only banks, is people are still looking for options. While they prefer digital-first banks, they want to have a human support when available or when they have an issue. And this is sometimes a place where trust can be broken, or often a reason why people don't shift or migrate completely towards digital banks. So it's also important to have this ability of support. So when working as business as usual and everything works perfectly, it's relatively easier to build trust. But if an issue comes up and you cannot resolve it over your digital bank, I think that's a place where trust can really break, and people might leave or switch to something that they feel is more safe or more stable.
Yes, and I think an important point here is designing for Gen Z and Alpha generations. Like, they are built differently, and traditional incumbent banks, they are not designed to serve them. But these new digital neobanks and fintechs can really gain market share by designing for these younger generations who want things to be done differently. They want transparency, they want community, they want honesty, and they can get upset very quickly, and then they will be conscious enough to go to a competitor, and they are just built differently in a way that they want more and they want things to be done, and actually in a digital way. So it's a very good edge and very good time for digital banks now. And that's where AI will come in as well. They are happy to communicate with an AI tool. And there's so many good case studies now that you can get an AI to roast your finances. You can, there's so many different applications of AI in this space. that can actually give a much better experience and a much more personalized experience. And Gen Z and Alpha are built for that. So it's going to be super interesting to see what happens.
Goodness, AI roasting my finances. It'll have to join the queue. Well, a bit of a tougher question, this one. Are there behavioural science techniques that some fintech companies have actually exploited? And if so, how can consumers protect themselves against these tactics?
Absolutely. So this is a very interesting topic. So we have to talk about first what influencing is and what are the dark sides of behavioral science. So we already mentioned that behavioral science says that people are unconscious and that they have two types of thinking, the unconscious and the more conscious way of thinking. And we can be influenced in the unconscious because we don't even realize what influenced our decisions. And as I mentioned, we act very quickly and make decisions in a predictable way because there are certain patterns and decision-making dynamics that we follow. And so this is where nudging comes in. And nudging is a tool of behavioral science that during these unconscious decision-makings can influence how you decide and what choices you make. And there are some principles when it comes to nudging. And then there are sludges, which are the non-ethical nudges. And so a nudge has to be, used for a good cause. People should be able to opt out of it. It shouldn't force anyone to do anything. And so there's this guideline on how it should look like. But then there are sludges which are using your unconscious in a way that's against you and you don't even realize it. So there's a lot we can see. So when it comes to, for example, some fintechs are encouraging gambling-like behaviors. They exactly know what kind of people will fall into that. And they are very well designed in a way not to discourage these kind of behaviors, but actually encouraging them. And also when it comes to crypto and meme stocks, there's a lot we can see around herd behavior and how people are bought into these different trends that are actually not good for them. But also just when it comes to, for example, Klarna and all these buy now, pay later solutions, their whole business model capitalizes on present bias, that people are not good at thinking about the future and making decisions that are good for the future me, and they want to prioritize the present me. And they are actually, they are built on this irrational behavior of ours. And in the US, there are statistics that people buy dinner using buy now, pay later. That's not normal, and that's not something that we should encourage, especially with the younger generations. Because until the age of 25, you don't have your prefrontal cortex fully developed. And so when you have these solutions available for you, but you can't really understand the associated risks, that's something that's very tricky. And a lot of solutions are built around this. And it's not protecting the user. It's more about profitability and capitalism. And that's something that should be very regulated. Most banks are very regulated, but when it comes to beyond banking solutions and fintechs, sometimes they are not as much, or regulations come in much, much later when there was a lot of damage done already. So behavioral science comes in from the regulator point of view as well. And there should be a lot more behavioral scientists should be employed when making these kind of regulations.
Goodness, yes. I think it's quite fascinating, especially when you were saying about people in the US spending, these say, buy now, pay later to get their meals.
Yeah, and this is where you can do something about it. So you can have rules for yourself. You can say I'm just not even going to touch buy now, pay later solutions ever. Because once you try to engage with them, then it's very tricky when to say no. So you can have some rules for yourself. Even if you had a bad experience, you can learn from it, and you can have some default settings for yourself that I'm not going to engage. If I can afford it, I won't buy it. So obviously we can be conscious about some things, but sometimes life makes it hard.
Of course. Well, I'd love to hear a real world example from you guys. So could you share with me a behavioural intervention you've actually put into practice in the financial sector, and what kind of concrete results did you see from that work?
Yes. So as we mentioned, we work a lot in the financial sector. And one of the solutions that we provide is personalizing tone of voice and how financial providers communicate with different user personas and user segments. And here again, we use psychographics. So we are measuring from behavioral data what kind of psychographic attributes people have. and then create segments using algorithms and segmentation methods based on these psychographics. And this helps us really understand how to engage these people and how to personalize their experience. And it's very interesting because usually what we see is that when we use these segments and then looking at their psychographics, then we see a big change in their demographic data and how they behave. So it's interesting to see that what we predict is usually what comes out of the data. And so usually we see some people who are very open, very independent, and they like to be more brave, they take more risks. But then there's people who are more settled, who are not about taking risks, who don't travel as much. And we have to communicate with them very differently because obviously they look for different things and think differently because of their personality traits. So what we can do is personalize promotional campaigns, personalize user journeys, personalize how a product is introduced to them. So, for example, we always have very good results, but in one of the studies that we did, we actually increased click-through rates by more than 100%, and then we increased sales of that product by 50%. And this works so efficiently because it's very easy to modify messages, and it's not a huge amount of work. You can use AI for it, but the results are incredible. And people will have an actually better experience because I feel like, oh my God, my bank actually is talking to me. They understand me. And then I can be more engaged with my finances.
I just want to bring another example that I think is quite different from this one, but we've done a project relatively recently with Volksbank in Germany, which was on the topic of generational consulting. And this is a solution for end-of-life health and wealth management. So people who want to manage their finances, or after they pass away, where their finances go, it can be based on building their family tree, really getting everything aligned. And this is a very, very emotionally complex and difficult topic. And what we've done for them is they had to move this entire process from an in-person service, consulting service, to an entirely digital service. And this is really, really challenging because you have to help throughout this platform to bring this personal touch, how you can create emotional support, how you can help especially older individuals follow through this journey, making it easy, making them trust the process, and really making it less emotionally straining wherever possible. But it also had a lot of complexity on, for instance, building your family tree online, or choosing what you want to wear or what you want to eat if you're in a state where you're no longer able to make decisions. So this is also something which we worked in on how we can utilize behavioral science to help make this the best journey possible from an in-person service to an entirely digital space. So that was also something very special and very unique.
Well, from just speaking with you off the show, I know you're super busy, but I think you're going to be increasingly so the more digital we become. So, because, well, finally, I mentioned earlier that we first met at Sibos, where, Rachel, I believe you were giving a talk on how institutions can use behavioural science to win new customers, what we've been kind of speaking about all today. But then I also remember walking past you, and not past you, but by a stage, and seeing a big version of you plastered up, which turned out to be an AI version of your future self. So firstly, I guess, how was Sibos for you? But what were the lessons that you took from your AI future self?
Yeah, Sibos was amazing. It was definitely a new experience. It was actually our first Sibos with BeHive. On the first day, I had the pleasure of giving a keynote talk, as you said, on the financial brain game, on how we can win more customers through the power of behavioral science. And I thought that was amazing because we had such a good response and openness and curiosity from the audience on recognizing the importance of applying behavioral science and a more human-centric approach to finance in general. So that was great. And then the second one, which you just mentioned, was this intergenerational dialogue. I was on stage with Julia Streets and Tony Fish, and this was a late-night show-style conversation where suddenly we had our AI avatars pop up. So for Julia and myself, it was a 25 years older AI avatar. For Tony, it was a 25-year younger version. And the 6 of us, I would say, had to interact across different topics of health, wealth, and just a bunch of different topics that our AI avatars actually asked us. So that was definitely the most creative and wild conference sessions I've done before. And in terms of the advice, so I didn't have that much time to talk to her, but there were 3 key things. One was, well, very obvious, but obviously it's important, was to take care of your body. So it told me to start stretching and do mobility. And I do have some issues with my knees, and it did make a point on that somehow. The second one was to pay attention to my gut, so taking care of what we eat, because the microbiome becomes our second brain, so we need to understand how we feed ourselves. It also shapes our mind, mood, and body and overall health, which again, good point. And then the third one was regarding taking care of your money, so investing early and not leaving my money or our money in my bank account. So those were the three. And then it also closed by saying that sourdough is overrated, which I don't agree with, but he also gave us that advice to the audience. So it was really an amazing experience at Sibos.
Not sure I agree with that either. And so you're telling me your future self didn't give you next week's lottery numbers?
Not yet, no. I have to talk more to her.
Disappointing. Okay, well, super, thank you again for sharing your insights with me today. But to finish our episodes, we always have our infamous FinTech Jail, where we ask for an industry term, buzzword, or trend that you have seen or simply just heard enough of and want to get rid. Or, of course, you can advocate to free one of the previously incarcerated terms. So, what will your choices be?
So I'm going to add a word.
You're going to add a word, okay.
And it's going to have to be gamification.
Okay.
Which I know is a bit contradictory being behavioral scientist, but what I feel, and let me know, Noemi, if you agree later, but I think this has become a very lazy word and misleading, and people like to throw it around and use gamification for everything. So you have some badges or a progress bar, and people say that this is gamification. So it's not the issue with the principle of gamification, but it's really the buzzwordification of this term, and people are really overusing it, and I would say are misapplying it. And I would really focus more on how we create more behavioral design to make it habit-forming, support sustained behavior change, making better financial decisions. So I think gamification needs to be first understood and applied better before we throw it around. So that would be my take.
Okay. Well, in the jail it goes.
So I would take out a word, which is co-creation.
Okay.
Because I think co-creation is super important. So as I mentioned, we have a multidisciplinary team. We co-create a lot, and also with our clients. And that's where the best solutions are formed. That's how the best solutions are formed. And I think people now need more and more just human connections and human experiences, especially as AI is growing and taking more and more space. So I think co-creation will be important, and it's going to be a great experience for humans. And yeah, I wouldn't take it for granted.
Well, Noemi, that's come across. You're very nice. You've saved one. Rachel, you've thrown one in. Okay, well. So that brings us to the end of the episode. I just want to say again, thank you both so much for sharing your insights. I think it's going to be, when this goes out, people are going to be really intrigued by what you guys are researching. But that is it now. Thank goodness, because I think our time's coming to an end in the room. Thank you so much again for joining, and have a great end to your time in London.
Thank you so much for having us.
Well, that's all we have time for this week. Thank you so much to Rachel and Noemi for joining me. As for FinTech Futures, you can find us online at fintechfutures.com, and be sure to follow us on LinkedIn to keep up to date on the latest FinTech news. If you like this podcast, you can subscribe on Apple Podcasts, Spotify, SoundCloud, or your favourite podcast service to get notified about all our future episodes. Thanks as well to Arama for editing this podcast. You can check them out at arama.tv. And as always, thank you to everyone for your support, and we'll see you soon for another episode of What the FinTech. But until then, goodbye.